Hi, welcome to another edition of Nucleus Investment Insights. Today we wanted to talk about the global bond route. Well, and to be a little bit more specific, the global 30-year bond rate route. We've seen a fair tick up in terms of yields at the long end. Not a lot of action at the shorter end, and actually at the very short end, yields have generally been moving down a little bit as looking for more rate cuts. But it's certainly raising some questions, particularly around valuations for equities and a whole bunch of other things. And so we thought it well worth jumping in and just talking about what's going on in terms of bond yields and how we're positioned and what our thoughts are about this going forward. Just a reminder that everything you hear today is general advice, it's not personal advice. See the show notes if you do want to book in for a meeting and have a chat to us about what is happening with you. So without sort of any further ado, let's sort of jump straight into the 30-year bond yields and just sort of have a look at what we're seeing. So particularly, I think the key ones that have sort of been capturing attention have been UK bond yields, which has sort of risen and I think 5.75% ish at the moment, and certainly given issues around sort of the Liz Truss moment a few years ago, that's sort of thoughts about what can go wrong there and what's happening. The US long-term bond yield has been sort of flirting with 5%, and so that's sort of like just I guess a bit of a round number thing there that's certainly been making some waves. And then the other one is a Japanese bond yield is sort of 30-year bond yield really has jumped up quite significantly. And there's actually a quite an important auction going on today that's sort of for 30-year bonds that I think is being globally watched in terms of just sort of seeing whether there's going to be more weakness there or not. There's a bit of an indicator of where we can go from here and whether if there is going to be trouble from here, what are the if there's going to be trouble then within the Japanese market, I guess is what the focus is. So so that's sort of what's going on. I guess that we've seen some stock markets coming back, and I think there's what you'll find is quite often when you see stock markets fall, there will be reasons given, and the reasons may or may not be the actual reasons. I suppose that's it tends to be that every time you see a stock market up or a stock market down, there needs to be some sort of reason given for it. And some of the effects have been sort of blamed on the long-term bond yields, and that might be true. But I think there's sometimes the line sort of drawn between them could be a bit too close, which is what we'll sort of jump into in a minute. So I might switch to Japan. So we're looking at these bond yields, 30-year bond yields over 3%. The 10-year bond yields in Japan have really stepped up as well. There's a whole bunch of things going on there. So so there's that bond auction today. The central bank in Japan has been doing yield curve control for a long time, and what they've been doing is forcing that long-term bond down, and they've been ceasing that. So what we're seeing is just I guess a more natural 30-year bond rate. So sort of way when we look back and say, I suppose there's pandemic lows, but even if we're sort of talking about some of these 1.5% to 2% yields that we saw through much of the last couple of decades around these bond yields, it's been a lot of that has been driven by the central bank there, and now this is the central bank sort of letting these go back to a more normal level. Also, you got the Japanese government looking to spend a fair bit more, and inflation really starting to make some signs like it's come back in Japan. So that's so sort of reasoning behind those increases in Japan. But the question is whether there's what this means for the carry trade. And the carry trade's been something which a number of economists and strategists have sort of pointed to as being a big reason for markets holding up as well as they have. And the idea there is that you borrow in Japan at 1% rates, and then you turn around and invest that money in US markets or somewhere else around the globe, and you get these returns on it. And part of the yeah, so you get the difference between what you borrowed at and what you can invest at. There is currency risk within that, but it's been a very successful trade in terms of the currency hasn't moved anywhere near as much as what just that pickup you're getting. So even if you've just been borrowing the money at very low rates in Japan and turning around and investing it into very safe assets elsewhere, that's been helping. That's been a pretty good, decent return. And so there's a strategist in particular from SocGen, Albert Edwards, who sort of looks upon the Japanese 30-year as being, one of the most important things out there, and he's talking about how this is going to be the harbinger for doom for the equity market and big falls in the equity market. Now, the only thing to say, so there's a whole bunch of things around that, but look, I guess Albert Edwards is sort of usually comes with the disclaimer, renowned bear, and there's a lot of stuff he does, take the negative view on. Not to say he's not right on a lot of things, but sometimes the answer is not necessarily that. He might have it directionally right in that this is bad for insert X, Y, Z, but it might not be a disaster in terms of where it goes. And so that's so that's where we're sitting with that front. So there are some potential issues around this, and I think it's worth watching. I think our take is that, look, when things move this quickly, you can see some dislocation, and particularly around if you've seen hedge funds with a particular strategy where they're sort of relying on low yields and they've banked it in, and then all of a sudden we get some sharp moves that can create problems. Usually, if it lasts for a little while or it's a slower movement, the hedge funds make losses, but it's not the fact that they're sort of going under or having these massive liquidity issues. And I think that's partly where we saw in the UK when we saw those long-term bond yields around the whole Liz Truss moment for that. Partly was genuine in terms of yields ticking up, but there was a trading strategy that a lot of the insurance companies over there had sort of embarked on, and when the rates jumped up, that sort of meant that all of a sudden they couldn't meet their obligations, and there was a question about solvency and all these types of issues going on for insurance companies in the UK. Now, one of the benefits of that happening is you sort of had that moment happen there. Every other hedge fund around the world then goes, oh, actually, have I got any of those trades on? Or all the risk managers then say, well, just a minute, yes, that happened in the UK, but are we doing something similar in Japan? And so if something similar happened in Japan, would we be exposed to that? And so while there might be, you can never rule out some hedge fund popping up somewhere that's really taken some bets on this that they probably shouldn't. I do think there's a reasonable chance that we've already had the fire drill a few years ago, and that means that the number of people who are exposed to that sort of theme and that would cause massive losses is probably not that high. The other things that it is going on is worth noting within the bond markets is you're not seeing a lot of stress elsewhere. So I'll just pop up a chart showing the 10-year US bond yields, and that's you can go day to day, minute to minute as to whether it's up or down, but broadly over the last 2 or 3 years, it really hasn't gone very far. It's sort of traded up to 5%, back down to high threes, and it's sort of sitting pretty close to the middle of that range at the moment. So there's not a lot sort of outside the ordinary going on there. And then if you look at corporate bond yields, so and I've done this as a spread, so it's basically looking at the triple B corporates, which are the sort of riskier but still investment grade bonds versus government bond yields. And so what it's basically looking at is how high is what's the premium you need to pay above government bonds in order to get into corporates. And what this tends to show is when you run into times of trouble, or when people are concerned, you get these big spiking up. But effectively, investors are saying, look, if I'm going to lend to a company, I'm going to need way more than lending to a government. And as you can see in that, we're basically at 10-year lows in terms of those spreads. So not a lot of signs of any concerns in terms of bond yields in either perspective. So we're really just talking about these long-term bond yields. And I'm going to go into a little bit more detail on the on the effects of those long-term bond yields on equities after this message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So the way this plays out in terms of stocks is that stocks are considered to be these long duration assets. So I'm buying stocks; they're going to give me these returns, hopefully forever, but certainly for a very long period of time. You're expecting those returns, and so the idea is that if long-term bond yields are moving up, so investors might have wanted 4.5%, now they want 5% on those long-term bond yields, then that's similarly a problem for investors. Is that the return that similar return for stock markets, in the return that investors are going to demand on long duration assets like stocks or long-term bonds is going up, and so therefore the value of stocks should fall down. And there's certainly a mechanical point of where you can sort of you can put through those valuations, but it really matters about the motivation. And that's the question. That's where there's large question marks over what's happening and what are the important reasons for it. So what do I mean by that? So there's, in a sort of classic valuation model where you did a discounted cash flow or something like that, you end up with this residual term at the end. So you model whatever number of years of forecast you want to do, and then you take that last term and it's a discounted growth model of whatever that value is divided by the discount rate minus the growth rate in the sort of perpetuity, so to speak. So if you've got and just to sort of put that into perspective, the discount rate, if you're talking about, say, a discount rate of 10% and a growth rate of 5.5% in perpetuity, then that sort of gives you a 4.5 on the bottom of that equation. And what does that mean in terms of multiples? Well, that's sort of like about a 22 times price to earnings or price to cash flow sort of multiple. And which is roughly where we are at the moment. So you said, okay, well, if we had a 10% discount rate and a 5.5% growth rate, that means the market should be trading on 22 times, which is where we are. And then you say, okay, well, what happens if that changes by, say, 1%? And then you go, okay, well, now I'm talking about an 11% discount rate on a 5.5% growth rate. So now you'd need your price to earnings to come back to 18.2. So you need sort of a 15%-ish fall in terms of markets to get you back to the same level. So, theoretically, if that was the type of move we're talking about, it's pretty dire in terms of the effect on valuations. And given they've moved up, say, about 0.5%, so that's sort of basically saying, that, all else being equal, that should mean that, stocks should fall, 7 or 8%. The most important thing there is all else being equal. And so really the motivations behind this are the important part, because if it's inflationary concerns, and I'm going to move into more detail about why it might be inflationary concerns, then within that mechanical model, you're saying, well, stocks are actually pretty good at picking up inflation relative to other assets, certainly relative to bonds. Bonds, if you're buying normal bonds, you're at the mercy of inflation. But stocks, if I'm talking about 1% higher inflation, say in the long term, then stocks are actually pretty good at picking up that 1%. And so, your discount rate might go up by 1%, but your growth rate might go up by 1% as well. And so, and that sort of leaves you back in the same place as where you were. So it's really this question about, is it more of a risk issue, or is it more of inflation concerns? Because more of inflation concerns, you can come back with reasons to say, well, actually stocks shouldn't be that much affected by it. Having said that, typically when you see interest rates move up, that is sort of seen as a negative for the stock markets, and certainly the initial reactions are usually for stock markets to come down. That's not always the longer term effect, though. Okay, so what else have we got going on that's sort of making a difference at the moment? So one is, it could be inflationary concerns. The other thing it could be that's sort of driving these yields higher is simply risk. So we've actually seen some of the shorter term rates falling. So we saw that I showed you a chart of 10-year bonds, which sort of really aren't moving much, but certainly some of the shorter term rates have been falling. That's because of the greater, increased expectations that we're going to see rate cuts at the short end. So effectively, we've got this curve steepening where short ends are moving down and long terms moving up, and that's sort of making different things are going on at different parts of the yield curve. Now, that's sort of this reflection that, look, maybe there is this increased risk. So Trump's obviously shaking up the natural order and trying to change a lot of things. So maybe this is just a risk premium around, look, we don't know what he's going to do. Maybe he'll decide to default on assets. Maybe he won't. Who knows? There's could be tariffs on, tariffs off. There's extra risk around, and so therefore we need this higher return for these longer term bonds. And if that's the case, you should see stocks fall off as well. If it's more about the inflation, though, and that I do think it is more about the inflation, there's a whole bunch of reasons this might be true. Now, the first is that government spending really has gone through a significant change in terms of perceptions. So, and even just since pre the US election. So at the US election, we had Trump talking about cutting back on the deficits, Department of Government efficiency, really getting in, rooting out costs, and bringing the deficits back to sort of more like 3%, and running a more stable government and things like that. Then we saw Elon come in, and for the first few months, cutting. It's all about the chainsaw on the stage and all these things like that. But the net reality of it after everything was passed was we're actually looking at increases in spending. And so within the US, it's sort of done depending on how much you believed before, but it's certainly done a significant change in terms of that. At the same time, within Europe, we've had Germany, which is one of the most fiscally austere nations, go from wanting to tap the rules to trying to work out how can they get around the rules, and maybe they can take a few things outside and change the definition and spend a lot more on military spending in particular right throughout Europe, and run higher deficits. And so it's this idea that, look, if we're looking at governments running higher deficits for a considerable period of time, then all else being equal, then inflation is likely to be higher in that longer term. And I think that's where a lot of this movement has come from in terms of that expectation for longer term bonds. The other thing with that is we haven't got the same sort of pushback. So it would be you're taking the financial crisis, for example, as an example. So we had this financial crisis. All of a sudden, high unemployment and all that type of stuff like that. We've got the Democrats in particular who were in power by the time the real waves were washing through, looking at all this big spending packages in order to stimulate the economy, and the Tea Party popping up at the sort of the right wing end of the Republican Party pushing back and saying no, we need to run, we need to live within our means and all this type of stuff like that. So you had sort of the yes, Democrats pushing, but you did have a reasonable part of the US electorate or electoral landscape sort of pushing back against spending too much money. That's not the case now. Now we've got the Republicans looking to spend it all as much as they can. It's really just a question of where. So you've either got Democrats looking to push into certain projects, Republicans looking to cut taxes and do things elsewhere. But net effect either way is it's extra spending. The bigger change is within Europe. So within Europe, we saw Greece, Spain, the pigs, Portugal, Italy, Greece, Spain, all running into problems, massive government deficits, and a lot of the northern economies within the euro, particularly Germany, Netherlands, really pushing back and saying, no, you got to be austerity. You can't push these. Now that's sort of gone away. There's there's some fringe parties obviously within Europe still pushing for those, but by and large, most seem to be on board with this whole idea of actually we're just going to spend lots of money. So so idea of higher interest rates is due to that higher inflation is clearly something which should be on the minds of investors. We're going through a bit of a slowdown at the moment, and tariffs and all these things happening, which is probably going to end up in lower interest rates in the shorter term. But I think the idea that we're going to, once we emerge from and get into more normal cycles, that the political environment has changed. It's not the same as it was 15 years ago, and now we're going to a sort of new regime of deficits don't matter, and politicians love that. I think there's one part to say, look, this is all being driven by the politics and the politicians, and I would argue that's not the case. Politicians are generally followers rather than leaders, and that this is this is the aftermath of seeing what happened during COVID, seeing all this money get spent from governments, and remembering that, hey, that's right, fiscal policy actually works, and you know what, voters love it when they get given checks and they get given all this free money. And so until you see a genuine pushback on that, you may as well hand money out as fast as you can. So that's one part. There's another couple of things going on here that I think well worth exploring, in particular some of the gold issues and some other things like that. I'll move into those just after this message.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So the other thing then that comes out of this is saying, well, are these bond yields rising because of other factors? Now, there's a whole bunch of other things it could be. One is that one is demographic issues. So this idea that as we saw the whole baby boomers retiring, there was a sort of push for bonds as they all wanted to get into safer assets. And now as baby boomers are starting to, that cohort starting to die off, that we've got people switching back into more aggressive assets and selling bonds and sticking into other assets. So maybe there's some truth to that. I think there's, the demographics can be overblown, I think, at certain points, but but there's potential that's possibly something behind it within some of the markets. Probably the bigger one is this idea about central banks. So a lot of this came from the Ukraine. When the Ukraine war broke out and the US and Europe seized a lot of Russian reserve assets, that sort of sent a bit of a shock through a lot of the smaller market economies. Any countries that are not so close to the US, and not even, you didn't even need to be, didn't need to be an enemy. You just needed to not be a staunch ally. So pick your emerging market country, whether it's Pakistan, Bangladesh, India, African countries, South American countries, wherever it is you're talking about. The idea that for those countries, do you want to be keeping your reserve assets in the US dollar if they might decide to expropriate them without warning? If you're doing something that you might think is right, that whatever it is, some land that you wanted to invade your neighbor to get back, that for historical injustices or whatever it is, that you might see those assets lost. And so that idea, I think, has got certainly some legs to it. And the idea that, or certainly, even if you're not going to, even if you're a smaller country, if you're not going to be maybe getting out of all your US assets, maybe you want to diversify a lot more than what you might have done before. And I do think that we're seeing that reflected in the gold price. So some of that strength we've seen in the gold price, I think, is related to some of this as well. And so I do think that's something, but on the flip side, if that was true, you'd probably sit across the entire bond yield curve. And so, and we haven't really seen it at say, even the 10-year bond yield, really be affected in the same way. But I do think, over sort of as a longer term trend, I do think that's sort of in, and then that's also increased as Trump's come to power. And you're looking at, say you're a country like Brazil, and all of a sudden you've got a 50% tariff because Trump doesn't like that you've locked up a mate of his, and he's sort of holding that over you. And the question about, well, will he also decide to hold over foreign bank reserves or something like that? And so that idea is that, well, look, maybe he won't, but there's it should at least it's at least one more reason to diversify some of your bond holdings elsewhere. So there's that one in it. I think there's the other thing is, in terms of funding issues, that sort of crops up as well. So if you were as these keep going up, say the US government, as it's issuing new bonds, they have to pay a lot more than what they used to, or the Japanese. So let's say that Japanese auction today, the yield will come out at whatever 3.5% or something like that, 3 to 3.5%. The 30-year bonds they were issuing 5 years ago, they had a 1% interest rate on. And so the idea is that there's actually 3 times the cost to government debt in terms of the interest they're paying. And so this is certainly true, but the reality is they issue bonds right across the entire curve. The 30-year bonds are actually not really used that much at all. It's a pretty small part of the market, and so yes, it'll increase the cost for governments in terms of issuing more debt, but not to as great of an extent as it's not sort of, while you can draw some direct lines and go, oh yeah, it's triple the cost of a few years ago. Yeah, but if you took an average of all the issuance they're doing right across the curve, it might be up 20, 30%. It's not up 300% across that. So the funding crisis in terms of these, a government's going to all of a sudden run out of money on the back of these 30-year bond yields. No, I don't think so. You'd need bond yields, across the curve to be rising, and we're seeing, short-term rates coming down, and so you just issue more short-end debt and less long-term debt if that was actually going to be an issue for you. There's certainly some risk concerns around the Fed independence. So we've seen Stephen Mirren, who Trump's got up as a candidate. He's talking in front of Congress yesterday, and I think again today. I think US time, I believe. So what are the issues around that? Look, I think there's a couple of different ways we need to look at this. Yeah, look, the Fed is probably going to be a lot less independent over the next few years than what it used to be, and that's of concern for people worried about worried about a Turkey-like situation where they force the interest rates down at the short end, and that leads to ballooning inflation and huge currency ructions and stuff like that. So that's potential, and certainly much higher probability than what it was, a year ago. The issue is, though, that so far he hasn't been appointing real lackeys to the position. It's not at the stage yet where he's appointing his son or his son-in-law to the Fed, or people without a lot of knowledge to these positions. Where the people he's putting up still are, they might be a bit more fundamentalist in their view about what's right and what's wrong. Stephen Mirren, for example, he's written a lot of stuff about the issues with the US and what needs to be done and what needs to be done on interest rates and currencies and all these other things. But it's not like he's come from a completely left field position. Like he's more of a Scott Bessent type person who, financial markets understand. Financial markets understand that he understands what the issues are. And the other thing is the person who Trump's looking to potentially replace as well, Lisa Cook, is actually one of the more dovish members. So in a way, just I guess in the next 6 months or whatever it is, that you're looking at this before we see a new Fed governor, you're sort of looking at saying, well, if I replace a very dovish, somebody who's already quite dovish with someone who's very dovish, it really probably doesn't sway the voting that much within the whole Fed mechanism. That's one part. Second part is, look, if it does become more less independent, it may not be the end of the world in terms of I think there's a couple of different ways you can look at it. If he's putting in, if you hear that Jared's being appointed as the Fed governor chair, and he's appointing his son and daughter-in-law as Fed members, yeah, okay, that's going to be pretty concerning, and you're probably going to see some sharp rises in interest rates in the US, for that. If it's more the way he's going at the moment, I think what you'll see is, we're really talking about a monetary policy that's much more similar to how monetary policy was done, 20 years ago, and maybe earlier than that, maybe 30 or 40 years ago, where what we saw was pretty much the central bank and the government working sort of together on this. So, you've got fiscal policy, you've got monetary policy, you can pull whichever lever is the right lever to pull. And you know what, if things go wrong, the government gets the blame for it. Whereas in a lot of ways, independent central banking is just coming back to saying, well, parliaments of the day can blame stuff on the central bank. And that hard part about interest rates rising that people hate, because, your mortgage is based on it. And so, if it's Albanese announcing that, hey, interest rates are going up and everyone's mortgage is a little bit more expensive, then everyone feels, that's obviously a big negative political thing, particularly in a place like Australia. Whereas if it's an independent central bank that's announcing it, okay, the blame can be apportioned elsewhere. And so, so I think Trump's going to end up in a position of, probably having a lot more say over that. May or may not be a good thing depending upon how far he goes, but it doesn't necessarily need to be the end of the financial system as we know it. If it's just a little bit less, or if it's less independent than what we saw, as long as it's still seen to be competent. I think in terms of that perspective, I think when you end up in the positions of what you've seen in Turkey, where you're putting people with express economic ideas that aren't met by or the opposite of what everyone else thinks, and they want to come in and show that this is how they prove that everyone else is wrong, and then find out that actually no, everyone else was right. And that's I think where you might see some real jumps and some concerns there. So it was that. I think there's what else did I have there that I wanted to talk about was, look, the US housing market, really important as well around this. So within Australia is relatively unique in terms of most mortgages running off a variable rate. And so really what the RBA and short-term, what the RBA's rate cut, when it cuts rates, that sort of flows straight through to the people. And that's very different to most of the rest of the world. So most of the rest of the world is more like a 3 to 5 year type range. So a lot of it, you get the effect, but it's delayed a little while. But still, what's happening at the short end will flow relatively quickly through to mortgages. Nowhere near as fast as Australia, but you still get that effect. The US is very different. So the US has got 30-year mortgages as by far and away the dominant form of mortgage. And so these long-term rates going up makes a big difference, and it does sort of spell a weaker economy for the US in terms of housing, in terms of spending on housing, and what we see within that market. That so that's not to be discounted in that long-term rates. So to get the housing market going, you really need those 30-year rates coming down, and that's not happening. So sort of increasingly a negative for that market. Fed independent. What else did we talk about? The trading issues. So I think around I spoke a little bit about that, about what happened in the UK. Back pre-2000, there was a company, big hedge fund called Long-Term Capital Management. They sort of put most of the financial system at risk in sort of the 98, 99, or maybe it's 97, 98. They put a lot of the financial system at risk. They're taking some really, really big bets on government bonds. And the bets themselves weren't inherently risky. It was sort of saying, okay, I'm going to buy buy an 11-year bond and wait for it to become a 10-year bond and then sell it. And so I'll go short the 10-year and long the 11-year and wait a year and close the position out. And so it's not a lot of risks to that. the thing was they used so much leverage, and then once their trading strategy got out and the amount, how big the leverage was, everyone else started trading against them, and then it sort of threatened to bring the whole sort of financial system down. When we're going through these types of things, it is worth thinking and watching and just being alert, saying, look, there might be somebody out there who's got some weird trading strategy and they've used lots of leverage, and we just need to be aware that when long-term rates are moving, what else might break. But spoke a little bit about the UK and having this trial run. It's less likely than in a usual case when we've seen this happen. So from an investment perspective, what does this mean? Okay, so alert, not alarmed, I think is probably the key one. We want to be careful of watching for sort of sudden moves within these. We want to be watching other parts of the bond yield curve. We want to be watching particularly some of the high yield and those triple Bs I spoke about, and some of the junk bonds. If those bond yields start blowing out, there's other things you can be concerned about. Within our own portfolios, we've been sticking for quite some time. We've been at the short end of the curve, very much focused on 3-year bonds. And so that's sort of been, that's been quite helpful. And those have sort of drifted their way into probably 2.5-year bonds at the moment for the most part. So, from our perspective within those, we're perfectly comfortable. We've been seeing interest rates falling in that part. And so, that's where bulk of, our tactical funds are invested in. If you're in sort of those longer-term bonds, you do need to think about, okay, what are the risks around that? Or the flip side is you look and say, well, at 5%, if I can get 5% on a 30-year bond yield, maybe you're happy with that. And that's sort of something you can lock in and say, well, for at least for a chunk of your money, lock in a 5% yield. If inflation's really high, you'll lose out. If inflation's low, you'll win out. But maybe a 5% return for a certain portion of your money locked in for the next 30 years is a good bet for many investors. What it is showing, though, this idea of this heightened uncertainty, and for us, it's very much about looking at earnings, company earnings still. So that focus we spoke about last week is that disconnects between the GDP and the company earnings is as stark as it's been in recent years. And for us, it's really about digging in and just focusing on those company earnings. If we can see, there's a lot of landmines out there and a lot of things that can go wrong. But if we keep seeing earnings growth and earnings forecast being upgraded, then and the economy not stepping on any of those landmines, then stock markets can certainly hold up under that environment. So so very much alert but not alarmed. We've got a fair bit amount of cash there, but we've still got some pretty big holdings in equities. Trying to keep a little bit of an each way bet, and looking for opportunities where stocks are beaten down. There's we recently sort of picked up a fair bit of AFSL, which is a big chip manufacturer. Or sorry, they actually make the machines that make the chips, but extremely high quality company. It's always been expensive. It's under a reasonable amount of fire now from Trump in terms of what they can and can't sell to China. Tariffs, not tariffs, all these things like that's going on. But in our view, it makes a product that nobody else can make, and that they're a high quality company, and that you just never get a chance to buy these stocks at cheap prices, and we've been given a chance in the last few months to do that. And so working out when we're seeing those is that some country will be targeted or some sector will be targeted, and just working out when do we want to be tipping into those sectors, and really just looking for high quality stocks that happen to be under the crosshairs of Trump or tariffs or whatever it is that sort of give you these pricing opportunities. Anyway, I'll leave it at that. Thanks everyone for tuning in. We're on every Thursday at 12:30. We on all sort of major and minor podcast platforms. If you do want to register Nucleus Wealth /content, we'd love you to hit the like and subscribe button and pop in any questions you have. I don't think there's a few questions today, but I think most of them are more just comments on what's going on. Thanks everyone for listening in, and we'll see everyone next week.